So you definitely know LVMH. We're talking Louis Vuitton, Tiffany, Dior. But what if I told you that a company built on champagne and handbags might have more in common with a high-tech chip giant than you'd ever guess? We're about to dive into a pretty fascinating comparison. Is LVMH secretly the TSMC of the luxury world?
I know. It sounds a little crazy at first. One company makes these beautiful things we dream of owning. The other makes invisible chips that, well, power pretty much everything. But what if the way they dominate their markets, what if their competitive advantages are almost mirror images of each other? That's the big question we're going to unpack today, and the answer might just change how you see them both. All right, to tackle a question that big, we can't just wing it. We need a proper toolkit. So, we're going to use a really simple but incredibly powerful investor's checklist to slice through all the market noise and get to the truth about LVMH. And here it is, our 3-point checklist. Is the company big, good, and cheap? First, is it a massive, dominant force in its field? Second, is it a fundamentally fantastic business with a real durable advantage, what investors call a moat? And finally, the killer question, is the market for some reason giving it to us at a discount? This simple framework is just perfect for spotting amazing companies when other people are running for the hills. Now, this whole idea leads us to a key strategy, and it's a little counterintuitive. It's called left side trading. See, most people chase stocks that are already going up. This is the exact opposite. It's about having the conviction to buy a great company stock while the price is on the way down, but only if you're sure the company itself isn't broken. It's all about buying fear, not hype. And this is totally central to the opportunity we're looking at today. Okay, our framework is ready. Let's put LVMH through the ringers. Starting with step 1, is it big? Oh, yeah. The answer is a resounding yes. It's not even debate. Just like TSMC completely dominates chip manufacturing with over half the market, LVMH is the undisputed titan of luxury. I mean, 75 legendary brands, a retail empire with thousands of stores, its scale is just staggering. In their own worlds, these two are the giants that everyone else looks up to.
And this dominance, it isn't just about being big. It's about being woven into the fabric of history. That quote, that's about Moet and Chandon, champagne, one of LVMH's brands. It was Napoleon Bonaparte's favorite. Let that sink in for a second. We're talking about Louis Vuitton, a company that started out making travel trunks for royalty back in 1854. You can't just go out and buy that kind of heritage. It takes centuries to build.
So, LVMH is big, no question. But is it good? Well, the evidence is pretty overwhelming. That brand heritage we just talked about, that's its moat. It creates this incredible power to set prices, and that power flows right to the bottom line. Look at that operating margin, around 26%. It's not just a one-trick pony either. It's diversified across fashion, jewelry, spirits, you name it. All of this with very little debt and under the legendary leadership of Bernard Arnault. This is the textbook definition of a high-quality business. This quote right here, it just captures the lightning in a bottle moment when Christian Dior changed fashion forever in 1947. But what really shows LVMH's genius isn't just owning brands like this. It's what they do with them. By the 80s, Dior was almost bankrupt. Bernard Arnault saw the incredible, timeless value buried in that history, bought the company, and rebuilt it into the powerhouse it is today. That is the good strategy in action. Big? Check. Good? Absolutely. So we've got this incredible, dominant, historically powerful company, and its stock price has fallen 30% from its recent peak. Whoa. Okay, this is where the story gets really interesting. This is where we have to ask, is it cheap? So is it actually cheap? Let's look at one key number, the price-to-earnings ratio. Just think of it like the price tag on a company's profits. Now, historically, investors have been more than happy to pay a premium for LVMH's quality, somewhere between 25 to 30 times what it earns. Today, that price tag is down around 22. In simple terms, you're getting a world-class business at a rare discount to what people have normally paid for it. And this is where everything we've talked about clicks into place. Our framework showed us LVMH is big and good. And now, the market has made it cheap. And why? Not because the business is failing, but because of fear in the wider market. This is the exact setup that a left-side trader dreams about.
And history shows that betting on LVMH during times of fear has been a pretty good move. Think about it. They survived the Asian financial crisis in the 90s. They made a bold, early bet on China when everyone else was scared, and it paid off massively. And they sailed right through the 2008 global meltdown. You see the pattern here, right? Resilience is just part of their DNA. So what could this opportunity actually look like? Well, you can see here that most analysts think the stock's fair value is a good bit higher than where it's trading now. Just getting back to that level is a pretty nice potential return. And if the company's growth engines really kick back into high gear, the upside could be even better. It's a clear picture of the reward you might get for being brave when others are fearful. But hold on. Let's be responsible here. No investment is ever a guaranteed win. The stock dropped 30% for a reason. So we have to do a reality check and weigh that potential reward against the very real risks. The anxiety out there, it's mostly about the big picture, not about LVMH dropping the ball. The number one concern is the economic slowdown in China, which has been a huge engine of growth for the entire luxury industry. Throw in worries about a global recession and just general negative sentiment, and you can see why the stock is facing some serious headwinds. This is definitely not risk-free. So how would a smart investor approach this situation? Definitely not by just diving in headfirst. The strategy is to enter in phases, maybe buying in a few batches to average out your price. You keep a close eye on the fundamentals to make sure that good story we talked about stays true. And maybe most importantly, you have to be patient. Value investing is a marathon, not a sprint. So after all that, what's the verdict? We ran LVMH through our big, good, cheap checklist, and you know what? The conclusion seems pretty clear. The analogy actually holds up. In its own universe, LVMH really is the TSMC of luxury, a dominant, incredibly high-quality leader that, thanks to a wave of market fear, is now trading at a very interesting price. And that leaves us with this one last powerful question. This company, with brands that have literally survived for centuries, has weathered countless storms. Right now, the market is essentially betting that this time is different. The value investor, on the other hand, is betting that it's not. And that tension, well, that's what makes this such a compelling story to watch.